Good morning. Welcome to Stock Market Today. It's Thursday, April 2nd, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com /today. Sign up for a free email where I get a lot of the content for this show. Also give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities were lower in Wednesday's trading, ending just off the worst levels of the day after finishing the worst quarter since the financial crisis. Treasuries were mixed with the curve flattening. Dollar was stronger versus the euro, but weaker on the yen cross. Gold was down 30 basis points. WTI crude settled down 80 basis points. And as we get to the desk this morning, a bit of a rebound. Futures are up about 1.5%, taking back some of the losses from yesterday. Asian markets were mixed overnight, with China and South Korea leading. European markets are mostly higher this morning. Treasuries are mixed with the curve flattening further. Dollar is stronger on the yen and euro crosses. Gold is up 60 basis points, and crude oil is adding nearly 10% on the day, snapping back here a little bit. So we got a pullback to start the new quarter. 2350 remains initial support. 2000 to 2100 are the levels to watch should 2350 fail. Resistance remains near 2650. We failed from that level after testing it a few times and started to pull back yesterday. The RSI is holding bearish ranges. Now, we still have this divergence in play, but really, to me, until we take out 2650 to the upside, this divergence is just something to be keeping an eye on. Not particularly actionable as far as I'm concerned just yet. Chaikin money flow is bullish but fading. You can see here how we've dipped back below this declining trend line. So indicators are mixed to slightly bearish. Still some chopping around below that 2650 level. Again, the futures are higher today. But for me, until we see any kind of move through that 2650 level, it's hard to get overly excited. Our base case remains a test down here is the higher probability event. Ideally, we'd love to see 2350 hold. Those are the lows from December 2018. So that's the structure of the S&P 500 here. You can see we are well below the 50 and 200-day moving averages. Taking a look at our market in a minute now. What are we writing about in the note today? Well, the rally fades as 2Q gets off to a bearish start. We are looking at downside retracement levels, right? Same as we used upside retracement levels last week and earlier this week. We'll start looking at the downside levels here today. Breadth metrics improve slightly but remain washed out. Software shows relative strength in the bear market, and that's, we want to continue to stay engaged and focus on the areas of the market that appear to be holding up the best, and software definitely fits that bill. We'll take a look a little bit later in the show. Futures point to a higher open here today, as I said. But first, the major indices from a power bar perspective, it remains a mess. The Dow down 4.6% yesterday, 0 bulls, 3 bears. S&P 500 down 4.5% yesterday, 3 bulls, 138 bears there. NASDAQ inline performer for the most part, 2 bulls, 25 bears there. Small caps, big underperformer on the day. You've heard me talk about small caps for some time. They were down by 6.9% yesterday, easily the worst performer of the majors. 53 bulls, 492 bears. Bonds uptick, sending yields lower, according to the Chaikin Power Bar. Small cap stocks and large cap stocks remain strongly bearish. The major indexes remain strongly bearish. Let's hit our stock of the day now. I get a lot of questions about this one, so I wanted to pull it out. This is not auto-generated. I picked this one for analysis purposes. It is Kroger. Kroger has a bullish rating. We take the 20 factors, 5 in each of these 4 categories. Financials are neutral. Earnings are bearish. Technicals and experts are both very bullish. So the 20 factors, 5 in each of these categories, give us this bullish rating for a stock that is in a strong trend. It is above the rising trend line. Industry is weak, as are most. So we look at the structure of the name here, though. It's kind of interesting to me. The rating just turned bullish recently. Continues to be an outperformer, is oversold with mixed to bullish money flow. So I think that if you were kind of looking for potential ideas in this environment, if you selectively were looking to pick spots, I think names like Kroger, who actually made some comments on their full year outlook yesterday, is the type of name you want to consider. Now, it triggered 2 of our alerts yesterday. Relative strength metrics kicking in here as the stock did have decent performance on the day. On the day where our market was down 4.5%, Kroger was up 1.25%. That's massive outperformance. So Kroger is certainly the type of stock that you want to consider if you were thinking about taking some swipes at the market here. As always, manage your risk diligently. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. So we go from all green to a mixed bag after yesterday's pullback. Staples, a defensive group where Kroger is a resident, remains at the top of the list, as does healthcare, right? Healthcare, one of the areas of the market where we've been focused of late. Utility is a traditionally defensive performer, and even after underperforming badly yesterday, they are still in the number 3 slot. Comms and real estate round out the 5 sectors that are bullish over the last 5 days. Tech, materials, and industrial are middle of the road. Industrials continue to be a mess. Discretionary and financials at the bottom of the list. Discretionary, obviously, the economic impact of COVID-19 going to wreak havoc on the discretionary landscape. And then financials, right? A lot of pressure here now. Flattening yield curve, lower rates. Now you're looking at an environment where there could be less demand for loan products, as well as the potential for losses on existing products. The financials are just under a tremendous amount of pressure here on an absolute and relative basis. Looking now at our industry in focus, the Dow Jones REIT Services is the group we're focused on today. This is auto-generated, and this group has been a massive underperformer over the past 6 months, lagging the S&P 500 by nearly 20%, 19.2%, and that power bar ratio, which measures future potential, is very weak. 25 bearish or very bearish stocks for 0 bullish or very bullish stocks. Now, we have seen a lot of that over the past couple of weeks. It's currently ranked number 19 of 21 subsectors. So names you definitely want to avoid in this group or that are indicative of what's going on in the group as a whole. Health Peak Properties, PEAK, UDR, ticker symbol UDR, and QTS Realty Trust, ticker QTS, all with very bearish Chaikin Power Gauge ratings. And if we look at the fund here, we can see that RWR is the ETF that's tracking our thoughts. Bearish ETF rating, weak trend below this declining long-term trend line. So been lagging since November. So now we have a bearish fund underperforming the market. Money flow mixed, right? Slightly bullish here in the near term, but had been persistently bearish. We are overbought. So just not an area of the market where I think it makes sense to be focused in the time being. Now, a lot of people like to gravitate towards the REITs in times of stress. I think that if you are going to kind of engage with that thought process, you really need to drill down and know what you own, right? Things that are levered to retail, obviously likely going to have a tough go of it. Areas that are levered to senior living in light of everything that's going on with coronavirus or COVID-19, having a tough go of it as well. So you need to take your analysis a step further. Don't just blindly say, I'm concerned about the market, so I'm going to hide out in real estate, because that hasn't helped you. The underperformance since November. So just something to keep in mind as you're going through your analysis throughout the day and days ahead. Looking now at what's trending. Yesterday's S&P 500 movers and shakers are gainers and losers. Newmont up 2.6% after completing the sale of a complex. Target rallying on those Kroger comments. Kroger made some comments on their fiscal year outlook, and that took Target along for the ride. Target up 2.5% yesterday. Letter K, Kellogg, no real company specific news there, but part of that Staples group that's holding in well. Regeneron, didn't see anything company specific here. It's actually been a name that we've been highlighting quite a bit. Regeneron up 1.7% in a down tape yesterday, has a very bullish rating. It was the best performer in the XLV on the day. Northrop Grumman up 1.5% as they filed a mixed shelf. That is a neutral stock. On the losers side of the board, Carnival Cruise Line, giving some details on the offering that they have ongoing. They increased the bond portion, decreased the stock portion, so investors took 33% out of the stock. Royal Caribbean, just further down lower in sympathy with Carnival. UAL and Delta down 18% and 16% respectively. Nothing company specific. There was some data out industry wide. And finally, Capri, which is levered to the consumer, was down 17.4% on the day yesterday. So, the theme on the loser side of the board remains in place. right? Travel and leisure continues to be an area that's shunned by investors. Violent moves in both directions. A lot of moving parts as some of these stocks need to now begin to raise capital. And like you saw here, it's really going to be the structure of those capital raises that seem to be driving trading in the near term. So let's hit the charts. On the way up, we looked at retracement levels to the upside, right? We used the February 19th high and last Monday's low to bookend where we could rally. And we saw rally attempts that made to the 38.2% retracement level, from which we have subsequently failed. So with that failure in mind, if we mark Tuesday's high and the March 23rd low, we can start to look at potential downside retracement levels if this pullback were to have some legs. Now, yesterday took us to the 38.2% retracement of this advance over the past week, right? Interesting to me that the 61.8% retracement level is roughly at $235. So lining up with that 2350 level in the S&P 500 that we've been highlighting here for the past week or so, right, is key support, right? Our base case remains a potential retest, and to me, that would be the level. If we could hold that 2350 level, I think that would be important in the base building process here for investors. So just something to keep in mind as that level now lines up with a fib retracement from the week-long advance or bear market rally that we did begin to see play out. I think obviously you want to be watching 265 to the upside, right? Because if we crack 265, those that 50% and 61.8% retracement levels to the upside that we've been showing start to come into play. So open-minded here, being nimble, laying out the playbook as we see it in potential support and resistance levels that we think are important and are likely on the radar screens of many technical investors in this market. So it's just something to keep in mind. We laid them out to the upside. I want to lay them out to the downside as well. As far as breadth metrics are concerned, slight uptick in the breadth metrics this week. You should expect that given the rally that we had, but we're still at washed out levels. And really what we'd love to see is just continuous improvement if the market did continue to rally. Now, the percentage of stocks above their 200-day moving average in the S&P 500, still below that 10% mark. And ideally, we'd love to see this start to get back up through 20 and 30%. To get excited that breadth is improving and that a rally is likely to have legs. We haven't seen that yet. So from a long-term perspective, and just given the velocity of the move down, I think this one's going to take some time to repair itself. On a more intermediate term, if we look at the percentage of stocks above their 50-day moving average, still at washed out levels down here around 3%. And again, we'd love to see this get back above 30 on rally attempts. And likewise, on pullbacks, right? If we pull back to that 2350 level, we'd love to start to see some higher lows, see those divergences start to play out. And just to take it a step further, percentage of stocks above their 20-day moving average, still an improvement. It's about 15% up from 3% last week, but still at washed out levels. So just something to kind of keep in mind there as we go through the process. My note today has a few of the other key indicators from a breadth perspective that I like to keep an eye on. And then finally looking at software showing relative strength. And in this case, again, relative strength is just less bad. Here's IGV pulling back, tried to undercut some of the recent lows. Now we have a rally attempt. Look for this 200 level to hold as support. Look for continuing improvement in the RSI, but it's the relative strength that's really piqued my interest here. As an area that's held up as the market has sold off. So as we begin to base, we want to pay attention to software. That'll wrap us up for today. Head over to shakenanalytics.com/test drive. Sign up for a free 14-day trial. Stay well, everyone. Have a great Thursday. I'll be back here with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.